After hitting all-time lows in the summer of 2020, interest rates have started creeping up gradually since August of last year. And in the beginning of 2021, rates have seen an even sharper increase in the first 3 months of the year, with a 10-year US Treasury rate sitting at just 0.93% on December 31st, 2020, jumping up to 1.73% on March 29th of this year. And with treasury rates being commonly used to price commercial real estate loans, the result of this has been increased borrowing costs for real estate investors in the first quarter of 2021, which could shake some things up in the industry throughout the rest of the year. So whether you're looking to invest in a deal over the next few months, or you just want to be prepared if an interview question is thrown your way around the impact of rising interest rates on commercial real estate, in this video, we'll walk through how interest rate increases might affect commercial real estate throughout the rest of 2021 and how property values might be affected as a result. So a prolonged rising interest rate environment is definitely not something most of us are used to here in the US, and if you're under the age of about 60, you actually haven't seen one of these in your entire adult life. In 1981, US Treasury yields saw record highs and capped out at an unheard of 15.84%, but aside from a few short bumps in the road, the general trend line for interest rates has been down and to the right for the last 40 years. And for businesses and investors, decreasing interest rates has been a really good thing, with a lower cost of capital fueling GDP growth that has skyrocketed over that same 40-year period from $3.1 trillion in 1981 all the way up to $21.5 trillion by the end of 2020, representing almost a 5% compound annual growth rate during that time. This time period has also brought a tremendous amount of change to the commercial real estate industry itself, transforming from really the Wild West in the 60s and the 70s to institutional investors taking real estate seriously today and making it a significant portion of their equity allocations. Back in 1980, institutional investor allocations towards real estate were just 2.1%, and the vast majority of commercial real estate in the US was owned and operated by private investors. But fast forward to 2020, and according to the annual Institutional Real Estate Allocations Monitor, target real estate allocations for institutional groups jumped all the way up to 10.6%, and over the last decade, institutional investors have consistently made up between 20 and 30% of annual commercial real estate transaction volume here in the US. During this time, though, the real estate market has been the beneficiary of about 4 decades of a relatively steady decrease in interest rates, which has arguably helped increase property values during that time period in the process, and we really haven't seen the effects of true sustained rising interest rates over time on the commercial real estate market as it exists today. But based on what we do know about commercial real estate supply and demand fundamentals and how institutional investors make investment decisions, if interest rates continue to rise over a period of 12 months or more going forward, I see a few things happening in the space, with some good news and some not so good news. So let's start with the not so good news and get that out of the way first, and that is that rising interest rates do pose a direct threat to commercial real estate prices, specifically by increasing cap rates, or the initial unlevered yield investors will expect when buying a commercial real estate property. When valuing commercial real estate, institutional investors that raise capital from third-party equity sources are really reverse engineering their offer prices by back solving to a valuation that allows them to hit the returns they've promised those equity partners, whatever those metrics might be. This means that if a private equity firm went out and raised $1 billion of equity to go out and buy commercial real estate and advertise that fund with a 15% IRR target for investors, that means that when that private equity firm is looking to buy deals that fit in that fund, that firm can only pay a price that allows them to reasonably believe that they can hit that 15% IRR in that deal. And as financing costs increase, this increases debt service payments owed on a monthly basis, which decreases the overall cash flow distributions to equity investors every quarter, making it harder at those same valuations to hit those target return metrics promised to investors up front. The end result of this is really these private equity firms adjusting their offer prices downwards until they can hit those target returns for equity investors to reflect the increased financing cost, which causes values to drop in the market as a whole in comparison to that going in net operating income an investor can expect when buying a deal. To put this into a more concrete example, let's take a look at how this might show up in practice by pretending we are a private equity firm with equity partners looking for a 15% IRR, 3x equity multiple, and a 10% average cash on cash return or higher on every deal we buy in the fund. Then let's say we're looking at a sample $10 million property acquisition being marketed at a 6% going in cap rate. We plan to finance that acquisition with a $6.5 million loan at 3% interest. And after running the rest of our assumptions on our operations and the sale of the property, our projections show that this deal would produce a 15% IRR over a 10-year hold period, an equity multiple of 3.14x, and an average 10-year cash on cash return of over 10.2%. And in this scenario, based on what we promised investors in the fund, we can afford to offer $10 million on the deal and still reasonably justify to investors why we believe we'll hit our investment targets. However, let's say that in that same scenario, all deal metrics were identical, except now rates have jumped up and our interest rate on the deal is now 4.25%, up from that 3% we used in the previous example. And if that ends up being the case, then all of a sudden at that same $10 million valuation, that IRR drops to just 13.6%, the equity multiple on the deal drops to 2.93x, and the average cash on cash return drops to just 8.7%, meaning that to hit our target investor returns, our offer price would have to decrease to just $9.5 million on that same exact deal, assuming all else remains equal. And when this starts happening on a wide scale and a lot of the market is pricing in this 5% decline in values, this is when property values start to shift and upward pressure on cap rates starts to creep in as a result. So as a blanket statement, that is the not so good news, but there's another side of the argument here that can make this a little easier to swallow if interest rates do continue to tick up, and that is that as interest rates rise, the cost to finance new construction deals also increases, meaning that fewer development projects pencil and demand begins to outpace supply in many markets as a result. So similar to what we just talked about in the first part of this video, developers are generally back solving to a land price or construction budget that allows them to hit their target returns, and financing costs are a part of that mix. If interest rates rise, this means that there will be fewer new projects that developers will move forward with and less new supply on the market. And with increasing demand in many product types, this is going to lead to rent increases both now and for projections in the future. And with future rent growth projected to occur, even with a rise in interest rates, this can actually keep cap rates low and values high in relation to the net operating income when a property is purchased today, essentially due to higher NOI projections later on in the hold period. So to use that same example scenario where rates jump up to 4.25%, what can save returns and values here are future rent growth projections that reflect increased demand in a market. So in the previous example, we assumed that annual rent growth was 3.1% per year, but if that rent growth assumption jumped up to 4.1% per year due to supply constraints and potentially a recovering economy, this is going to make our returns and our valuation as a result look a little bit different. So if we add that assumption to our model, our returns at that same $10 million valuation now jump back up to a 16.3% IRR, a 3.6x equity multiple, and a 10.1% average cash on cash, meaning we can still put an offer in at the seller's full asking price and have the confidence that we can hit our return targets on the deal at that valuation. And if that's the case across an entire market among a pool of buyers, that means that cap rates and property values might actually not end up going down in a rising interest rate environment. And for investors primarily focused on an IRR or equity multiple metric, these values might actually increase in a scenario like this. Now, obviously, our good news isn't always good news because projections are really just educated guesses about what we think might happen in the future. And if 2020 taught us anything, it's that there are unforeseen events and circumstances that make your projections wildly overstated or understated depending on what's going on in the world at a given time. But with that said, if investors are taking a bet and making assumptions that rent growth will accelerate in their pro formas, this would likely be enough to keep cap rates and values relatively consistent in many cases, even as interest rates continue to rise. The issue here becomes when investors start to underwrite rent growth that isn't really backed by research to just push values and make deals pencil. And this is where investors have historically gotten into trouble. But if economic conditions continue to improve throughout the rest of the year, the unemployment rate continues to drop, and lumber costs continue to rise at historic highs, the increase in expected figures in many US markets could partially or fully offset the potential negative impacts of rising interest rates we might expect to see on CRE pricing. So if you're looking to buy a deal this year and want to know how this might affect you, or you're preparing for an interview and want to be able to talk through this, I hope this was helpful. And if you're looking to go deeper into understanding the analysis behind the impact of rising interest rates on your deals and the various different loan structures and how to model those, make sure to check out Breaking a CRE Academy, which includes courses that will walk you through the process of modeling things like interest-only loans, refinances, floating rate debt, future funding, and construction loans. You'll get instant access to a library of pre-built acquisition and development models so you can practice what you learn in the coursework in real time, and you'll also have access to one-on-one email-based career support to get questions answered on your own unique situation if you're navigating the job search process and need some extra help along the way. And if you like this video and want to see more content like this on current events and the economy as a whole on this channel, make sure to hit the like button to let me know, and also let me know in the comments where you see interest rates going throughout the rest of the year and what kind of impact you think that's going to have on commercial real estate values. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every week, and I'll see you in the next video.